What's up, everyone? It's March Madness. My brackets are looking awesome. I think I've got Baylor winning both brackets. And I got a couple of futures on a couple other teams from before the season started, but hope your brackets are going good too. So while you're watching your teams play, here's something in between the games that you can watch that could benefit you down the road when it comes to real estate. And today we're talking about some hidden benefits to real estate that aren't talked about all the time, and also kind of some real estate myths or debunking some of the things that are being said out there about real estate right now. So first, I bet you didn't know you can write off all of your property taxes. You can also write off your mortgage interest. And the year that you close on your home, you can sometimes actually write off the closing costs on that as well. So whether it's your personal residence or an investment property, these are a couple of things that people kind of forget about, especially with investment properties when people are going through the cash flow statements, your internal rate of return, cap rate, kind of those items that we talked about in previous videos. Something people forget is you're actually saving some money too if you write off those property taxes. So you might not be getting any money, but you're saving more than you would have to pay. Hidden benefit to real estate number 2. So I'm going to start off with saying I saw something on Instagram a while ago, and it was somebody saying that buying a house is a terrible investment. You're actually losing money over time. And quite frankly, it actually kind of pissed me off. So the example that they used was, it was something like a $100,000 property that someone purchased. If you held that for 30 years, the appreciation wouldn't outperform the inflation rate. And the amount of money that you paid on that loan over the 30 years was much more than what the home was worth when you purchased it, which is true, that's part of it. But what people forget is when you're paying that mortgage every single month, a majority of that's going towards principal. So you're actually paying equity, you're building your net worth. So you've got a diagram where what you owe is slowly decreasing, slowly decreasing, slowly decreasing over 30 years. You've got the second diagram where your property is appreciating, appreciating, appreciating. So even if the value of your home is going up the same rate as the inflation rate, what you owe is going down and down and down. You're getting that much closer to owning this piece of property outright. Now, I don't remember if this example was to say that renting was better, and sometimes renting is better. I'm not going to downgrade or downplay renting either. But would you rather be paying $800 towards a landlord and increasing his net worth than paying an $800 mortgage going towards your net worth and owning an actual piece of real estate? Which is one of those main factors that everybody talks about America, you know, the American dream, owning a home, having a great job, having a family, all that good stuff. And this kind of goes into the hidden benefit number 3 to owning real estate. Cash flow is not always king, and I'll tell you why. Yes, the ideal situation is making, $100 to $1,000, sometimes $2,000 per month on top of what your principal, interest, taxes, and insurance is, PITI. Making this chunk of money over here every single month, and the property is being paid off from the tenant's rent. That's the ideal situation. But there are situations where it's actually not a bad thing to not be cash flowing. For instance, this happens in California and Florida and New York, all these big cities. This happens everywhere. Investors will buy a $1 million, $2 million, $3 million place, rent it out for $20,000 per month, let's say. But the expenses every single month together run about $40,000. So that owner of that property is actually losing 20 grand per month. Or are they? So yes, they're receiving $20,000 per month, they're paying $40,000, they have a deficit of 20 on this $1 million property. But guess what? Those properties are appreciating 3, 4, 5% per year. That $1 million property after year 1 is now worth $1,030,000. So that still hasn't covered that $20,000 deficit, but it takes a nice chunk out of it. Now, remember what I was talking about writing off property taxes? Well, guess how much they're writing off on the property taxes on a $1 million property in California? And a little bonus, they can write it off as a loss when it comes to tax season. So when you write it off as a loss come tax season as well, you're also saving a ton of money on that end. Now we can shrink this down into a more realistic scenario. Instead of $1 million property, let's call it a $100,000 property. Same principle applies. You might be losing $100 a month or $200 a month, but all those write-offs, and if you do write it off as a loss as well, if your income doesn't match what your expenses are and your property's still appreciating, you're actually going to be in the black when it's all said and done. And it's really, really nice if you're in a high tax bracket and you can write all this stuff down. Now, number 4 example here, I'm actually it's kind of a combination between a benefit and kind of debunking one of those real estate myths, but it's that common question of, should I pay down my mortgage, an extra $50 per month, over 30 years and try to get that so I own this property, you know, in 26 years rather than 30? Well, it all comes down to your situation. So many of you may have heard of Dave Ramsey, and he is a huge proponent of paying off that mortgage as quick as you possibly can. But I'm one of those people that kind of disagree. Sure, it'd be awesome if you could pay, instead of paying over 30 years and paying interest on that, you end up paying it, you know, for 25 or 20 years, depending on how much you put in extra per month. But I'm a strong believer in good debt and bad debt. So in my case, I'm using my home as a rental property as well. So instead of taking some of that cash flow and applying it to the principal, I'm actually just pocketing that money because I got a really good rate. I don't really need to pay it down. I'm making good money on the side. And that's kind of a mixture between my personal residence and a rental property, but it ultimately comes down to your current situation and what you're comfortable with. Hidden benefit number 5 kind of goes in today's current situation, March 28th. Interest rates just rose to 3.5%. That's way too much. I'm gonna wait until they go back down to 3, 2.5, 2.25. Even if rates go back up to 6%, we are still at historic lows. They've never been lower. The highest interest rate we have seen in the last 10 years was in 2019 at 5.34%, I believe. The next highest interest rate we have seen was in 2011 at 5.05. So even if rates go up to 4.5%, they're still lower than they've ever been in the last decade. So don't be alarmed when you see on CNBC interest rates are skyrocketing. The 10-year treasury is going crazy. It's up a whole percent. Interest rates are still extremely, extremely low. And don't let that rising interest rate, when it happens, if it happens, don't let that discourage you from purchasing a home, because you're still getting a great deal, actually better than you would in the last decade right now. Hidden benefit number 6 is something that we can't really control, but it is kind of a benefit, especially when you purchase a property, if you get a good deal. So it's kind of a conditional benefit, but it's appraised value. If you've been watching the channel for quite a while, you know a little bit about appraised value. I talked about it a little bit in a couple of the other videos. But essentially, if your appraised value is higher than what you purchased it for, you get free equity in your home. So say you and your agent find a property that we think is a little bit undervalued. It's in great shape, but the property value does not reflect what everything around it is selling for. So say you find a $100,000 property, you go through the purchase process, and the appraisal from the bank, you're gonna have to get an appraisal when you purchase a property with a loan. If that appraisal comes back at $110,000, you literally just got $10,000 for free and free equity towards your home for seriously doing nothing. Maybe a little bit of digging and data analysis and stuff like that. Didn't really do much. Believe it or not, it does happen quite often, and we're probably going to see quite a bit of it in the upcoming years, because as you know, property values have been increasing like crazy. And in this part of the benefit to appraisals, you can get an appraisal after you purchase a property as well. As I mentioned in previous videos, with appraised value, and then you got natural appreciation and forced appreciation. Say you hold that $100,000 property that appraised for $110,000. Say you hold that for 2 years and you put 20, 30 grand into it. After those 2 years, you can get that place reappraised. You can really reappraise at any time. But say you hold it for 2 years, that property might appraise somewhere in the 160, 170 range. I'm not a genie, I don't have all the answers, but you bought the place undervalued by $10,000. You put 20 or 30 into it, and now it's worth 160, 170. There's about a $50,000 or $60,000 difference there, and if you decide to sell that place, you just made $25,000 a year for holding that for 2 years. So to kind of wrap this up, there's a ton of other benefits to it. These are just kind of what came off the top of the dome at the moment. But if you have any questions about real estate, anything like that, give me a shout. I'd be happy to answer any questions for you and hopefully get you into home ownership at some point if you're not already. Thanks for watching. I'll see you next week.